Hello students, I hope you're all doing well. Welcome to another video by QuickStudy. This video covers the calculation and interpretation of cash flow from topic 1.3, putting a business idea into practice. So without any further ado, let's get started. In this video, we'll learn about net cash flow and cash inflows and outflows and how can you calculate the opening balances and the closing balances of cash. So firstly, we need to know what is cash flow. Cash flow is basically the difference between the cash coming in and cash going out of a business over time. If I had to give you an example, a business spent £20,000 in its first month of operations to buy premises and to buy inventory, and the business has only received £1,000 from the sale. Say, for example, the rest of the sales was on credit. So if I were to create a cash flow statement, the final balance or the cash flow for the statement of my business would look as negative 19,000. And now we would also need to know what is cash flow forecasting, which is basically making a prediction of the cash inflows and outflows so that we can estimate a bank balance at the end of each month. And this is typically done for 12-month period, but you could also do it quarterly, like every 3 months, or you could do it biannually, like every 6 months. And it's important that your cash flow forecast is successful because whatever predictions that you have come up with, it should reflect on the results that you have achieved, right? So how do you make sure that your cash flow forecasting is successful? First of all, you need to make an accurate prediction of your monthly sales revenue. And you'd also have to make sure that your customers are actually paying you on time, or there should be a definite time period. You should know when your customers are going to make payments to you. And at the same time, you would need to be careful about the money that you're spending on your operating costs. You'd have to carefully allocate these costs. And you'd also have to consider when are you making payments to your suppliers. Then there are other factors that you should consider as well, because a business might need to buy additional capital or may need to raise additional capital. And the business spending large chunks of money on buying capital equipment such as vehicles or premises costs you a lot of money. So you would need to be aware of these expenses ahead of time so that you can make preparations accordingly. So first of all, you need to understand that cash flow forecast is a prediction, and high accuracy in a prediction is very difficult to make, and it's especially true for small and new businesses. So this is actually one of the main reasons which leads to business failure for new and small businesses, because they cannot accurately predict their cash flows. And poor cash flow compared to your forecasted cash flow is it could lead to a very serious consequences for banks. So businesses should communicate about this issue with their banks clearly, because this is exactly how banks can lose confidence in a client. And it might be the case that they can ask you to repay the overdrafts within a 24-hour time period, which would make it nearly impossible for new and small businesses to continue trading. So what can you really do? First of all, you need to understand that businesses need to have a very effective cash flow management practice in place, and also make sure that their forecasts are accurate. And this is critical for business survival and growth. And you could also build and maintain strong relationships with the financial institutions. And maintaining an open communication with these institutions can help mitigate some of the risks that are involved in creating cash flow forecasts. Now we need to understand why cash flow forecasts are important. Well, cash flow forecasts can provide critical insights into a business's available timing and amount of cash that can help a business to plan effectively, avoid financial shortfalls, and maintain smooth operations. So cash flow forecasting is especially important for three types of businesses. So firstly, there are new firms. Startups will often face unpredictable sources of expenditures and revenue streams, and accurate forecasts can help manage these initial cash flow challenges and secure the necessary financing later on. And then secondly, there are fast-growing firms. So fast-growing firms means a rapid expansion, and which can strain the cash resources that you have. And forecasts can ensure that the growing firms meet the increasing operational expenses and the capital expenditure requirements. And then thirdly, we have got businesses with erratic sales. These are basically businesses who have seasonal or irregular sales, and these patterns are very difficult to deal with because at times there are very high amounts of cash coming in there, then there are times then there is very little cash flow. So if I were to give you an example, a firework factory has most of its revenue or sees most of its revenue come in during the October November period, but they have still got bills to pay from the January till August period, right? So forecasting can help manage these cash reserves to sustain the business during the off-peak months. And now we are going to talk about negative cash flow. So what is negative cash flow? Negative cash flow is basically when the firm's cash outflows are greater than the firm's cash inflows. And this basically means the firm is operating in the red. And is it sustainable? In the short run, yes. Operating with a negative cash flow can be done for a business provided that they have an overdraft facility in place or other sources of capital. However, it is important for a business with a negative cash flow to make sure that they are looking for ways to improve their cash balances or their cash flow, because in the long run they may face financial issues if the cash flow issues are not resolved. So now we need to look at what are the different ways in which we could improve our cash flow, right? So the first way we could do that is to cut the stock levels, which essentially means to reduce the amount of money that is tied up in stock. And that would translate to ordering less from your suppliers so that the money that is associated with the cash outflow is staying in your bank account. If I were to give you an example, if you're ordering 40,000 pound less worth of stocks from your suppliers, it would mean that you have 40,000 pounds more in your bank account. And now for the second way that you can use to improve your cash flow includes negotiating better payment terms with your suppliers, which basically means you are going to increase the amount of time that you take to make payments to your suppliers. You see, when you are delaying your cash outflows, it's basically improving your cash flow. And the third way you could use to improve your cash flow is reducing the amount of time that it takes to collect money from your customers. What it essentially means is that you would give your customers less time to pay back to you. And accelerating payments from your customers would mean an improvement in cash balances, right? However, it comes with a but. Now, some of your customers might go to a different supplier who are offering better credit terms or a longer payment term per se. Now, everything has a plus side and a negative side. What would be the best thing to do in this particular situation is to avoid customers who are usually late in their payments, but rather focus on customers who are keen on making payments early. And students, it's very important that you make your cash flow forecast carefully. What this does is help you earn the bank manager's confidence, and at the same time, it will make it much easier for you and also cheaper to borrow money when the business needs additional cash. You need to keep in mind that the cash flow forecast has to be conservative and needs to be prepared carefully. And what this means is that when you are forecasting for the cash inflows, it has to be kept low. Whereas when you're forecasting for the cash outflows, you're going to keep in mind about the worst case scenarios possible. And what this does is that it ensures that a positive deviation is well received and the forecasts are favorable. And there are benefits that you can enjoy from preparing a cash flow forecast that is carefully assessed. First of all, what it does is that it enhances the credibility of the business for the financial institutions, and at the same time, a conservative forecast that turns out to be better than forecasted is basically strengthening the business's reputation and financial stability. And now, students, we are going to take a look at how to calculate the cash flow balances. Now, if you were to look here, this is an example from the book. It says there are 10 gaps in this cash flow forecast shown by the letters A to J. Think about the numbers that should fill each gap, then check against the answer shown below. Now, this is an incomplete cash flow forecast, and for the month of January, we have the opening balance as 50, the cash inflows as 140, the cash outflows as 160, the net cash flow is a negative 20, and we are required to calculate the closing balance, which is marked as the letter A, right? Yes, we are supposed to calculate the closing balance, which is marked as the letter A. Now, to calculate the closing balance, we are going to look at here. There is 50 at the beginning of the month, right? And during the month, since you have had a negative cash flow of minus 20, which will further reduce your closing balance by 20, which means that your cash flow during the period is reduced to 30, right? The answer is marked here, as you can see on the screen. Now, for the month of February, we have the opening balance as 30, and the cash inflow is marked with the letter B, and we have the cash outflows as 180. The net cash flow is 40, and the closing balance is again marked with the letter C. So this is something that we'd have to calculate. Now, how do we calculate the letter B, or the cash inflows? For that, we are going to use the formula for the net cash flow, which is cash inflows minus cash outflows, which will give us the net cash flow. So if we were to put the numbers here in the formula, the answer would come out to be 120, right? So this is how we have calculated the cash inflow for the month of February, which comes out to be 220. Now, moving on, we are supposed to calculate the closing balance for the month of February as well, right? So to calculate the closing balance, the formula is given here as closing balance equals the opening balance plus net cash. And when we input the numbers here in this formula, the answer will come out to be 70. Right, which is basically calculated by adding the 30 in the opening balance with the net cash flow, which is 40, which gives us 70. Now, the closing balance for the month of February, the letter marked C, is 70. Now, moving on, for the month of March, we have the opening balance as 70, the cash inflows as 240, and we are supposed to calculate the cash outflows, which is marked with the letter D, right? Marked with the letter D. And we have the net cash flow as 60 and the closing balance is 130. Now, to calculate the cash outflows, we are going to use the formula for net cash flow, which is cash inflows minus cash outflows, which will give us the net cash flow. And when we input the numbers in the formula, the answer will come out to be 180 for March, which is basically the cash outflow. So the cash outflow for March is 180. Now, moving on, for the month of April, we are supposed to calculate the opening balance, which is marked with the letter E. Right? Now, how do we calculate the opening balance? So we don't really need to calculate the opening balance here. The opening balance is basically the closing balance from the previous month. So the previous month was March, and the closing balance for March was 130, right? So the opening balance for April is going to be the closing balance for March, which is 130, right? And then we are supposed to calculate the cash inflows for the month of April, which is marked with the letter F, right? And how do we calculate the cash inflows? We are going to basically use this formula, which is basically the formula for net cash flow, which is cash inflows minus cash outflows, which will give you the net cash flow. And when we input the numbers into this formula, the answer will come out to be 190 for April, right? And this is how we have calculated the cash inflow for April. And then we have the cash outflows for April at 220, and we have a negative net cash flow of 30, right? Then we are supposed to calculate the closing balance for the month of April, which is marked with the letter G, right? How do we calculate the closing balance for the month of April? We are going to use the formula for closing balance, which is closing balance equals the opening balance plus the net cash. So we are going to add 130 and then plus minus 30, since we have a negative cash flow. The answer will come out to be 100. So the closing balance for April is 100, right? Then moving on towards the month of May, we have the opening balance as 100, the cash inflows as 210, the cash outflows at 220. We are supposed to calculate the net cash flow, which is marked with the letter H. And we have done this before. We are going to use the net cash flow formula to calculate the net cash flow, right? Which is cash inflows minus cash outflows. And when we are deducting the cash inflows from the cash outflows, the answer comes out to be negative 10, right? So our net cash flow for May is a negative 10. And then moving forward, we are also supposed to calculate the closing balance for the month of May, which is marked with the letter I. And how do we calculate the closing balance? We will calculate the closing balance using the formula where we are adding the opening balance with the net cash, right? And when we input the numbers into the formula, the answer comes out to be 90 for the month of May, which means that the closing balance for the month of May is 90, right? Then moving on to the next month, on June, we are supposed to calculate the opening balance, which is marked with the letter J, right? And here again, we don't really have to calculate anything. The opening balance of a month is basically the closing balance of the previous month. So the opening balance of June is going to be the closing balance of May. And as we have calculated the value of I in the previous step to be 90, so the opening balance for June is also going to be 90. And students, that is how we calculate the cash flow balances, which includes the opening balances, the net cash flow, and the closing balances. Alright students, with that we have come towards the end of this video, and to give you a short recap, this is what we have covered in this video so far. We have learned about how to calculate the cash flow balances, which includes the net cash flow, the opening balances, the closing balances. We have also learned to interpret or understand what cash flow is, what are cash flow forecasts, and why is it important for us to do. And then we have also learned about negative cash flows. So students, I'd like to thank you for watching this video, and if you've liked this video, do subscribe to our channel, since we post regularly on different topics and subjects that can help you ace your GCSEs. And for more information on our online tutoring services, do visit our website at www.quickstudy.uk. Thank you.